And right now, you have to be so careful about who you listen to on the TV, because they're equating now, economists are equating now a slower economy with lower interest rates. If that were true, then Zimbabwe's economy would be booming, and Venezuela, people would not be eating out of garbage cans. This is not true. All these economists, they have the same problem. They believe the textbooks that they had in college. So, my degree is in chemistry, but I took 2 years of economics just to find out why economists are always so wrong. We see once in a while the former Federal Reserve Board members giving their opinions on the economy. And I shouted them, and they're all professors now. And I really pity those poor students. We said about a year and a half ago, we're going to go into a period of time that'll be terrible for people who are not informed.
Correct.
And I agree with your depression. I've been saying that. In fact, in early 2020, we wrote that we're going into a depression. If you want a roadmap, just read about the Great Depression of the 1930s. It's going to be very, very similar, except it will be worse.
Right.
Probably will be much worse. They have printed so much now, they can't print much more.
No.
And we saw a warning signal. Usually before these events, like Lehman Brothers and so on, you have several smaller events that don't get much attention. In fact, the default rate on subprime mortgages was soaring in 2007. And Bernanke said, that's an isolated situation. Nothing to worry about, no recession in sight. And then, of course, we had the Lehman Brothers crisis in 2008, and everything fell apart. When suddenly the pension plans had to sell their leveraged treasury bonds, or gilts, as they're called in Britain, they were leveraged. People had no idea that pension plans can use leverage and derivatives. This is incredible. Nobody knew this. No. So suddenly they got margin calls. They had to sell their gilts to get money, and there were no buyers for the gilts. So the Bank of England had to come and buy the gilts from the pension plans. Otherwise, the pension plans would have gone bankrupt. And this was the canary in the mine. This is going to happen. We have $177 trillion of derivatives in the United States. That is an unbelievable amount, 177 trillion, not billion dollars. And you know that the four biggest banks in the United States hold 90% of those derivatives.
Correct.
Four banks. This is the time you want to be in the minority. And I'm not talking about racism. I'm talking on the monetary side. And when we gave this advice that we're going to go into the opportunity of a lifetime, we said. Yes. And it's not buying. It is, we said, go and sell short. You sell short stocks. You shall sell short just about anything you can think of that everybody has been piling into. Sell it short and you will make money. They now have ETFs and they do this short selling for you. They are designed to rise in price when the index or the sector declines. Okay. And that makes it so easy because most people cannot understand the idea of selling something that you don't own. Okay?
Yes.
And that's what short selling is.
Yes.
And so these ETFs, and they have them on the indexes like the S&P, the NASDAQ, etc. They have, for countries, they have these inverse. They call them inverse ETFs. And that is the easy way. You just buy them and they go up. They soar in price as the market collapses. You know, you just said something very important, what everybody is into. Everybody's into options. This is incredible. And, you know, when I started my business in 1977 in Honolulu, downtown, okay, we recommended options, okay, it was great. And then in 1980, we got a sell signal on gold, dropped through $694 and said, that's our bear market signal. Now you want to do exactly the opposite. Instead of buying call options, you buy put options. So at the end of 2 years, our put options were actually worth more in some cases than the mining stocks that were underlying those. It was fabulous. But here again shows there's nothing forever. What goes up will also go down. Now, you talk about precious metals, and I get this question very often. What should we do? And it's always good to have some insurance position in gold and silver. I kind of prefer gold, but what I really prefer is the mining stocks. The mining stocks, they're not going to confiscate. With the way the government here is right now, it's also very similar in the 1930s, where the government confiscated gold. Okay?
Right.
So we could see that again. But they're not going to confiscate mines, gold mines. Okay? So you can't be sure about anything over here right now.
No.
Yeah. Things have changed. So, but one thing, you have to be very careful because the people on TV, they're going to start saying when the Federal Reserve pivots. Pivot is now the word. In other words, when the Federal Reserve changes from quantitative tightening to quantitative easing again, someday in the future, okay? And then they say that's when you really want to buy gold. And in my opinion, well, not in my opinion, research shows that once the Federal Reserve starts easing money from a tight monetary pressure, that's when the biggest part of the stock market and the gold mining stocks appears. They tank when the Federal Reserve eases. And this is always a big trap. People think, oh, the Federal Reserve is easing, now we got to buy. No, it isn't. If you look at the charts, this is when you have the last big, strong drop in all of these assets.
Right.
So you got to be very careful. And that's why, the last time I was on your program, I said, if you look for an advisor, find somebody who has been in the markets for at least 44 years.
Right.
Why 44 years? Because they remember 1978, 1979, 1980. That was a very important period. It was the last peak in inflation in the U.S. What's really important here is to know some history. And many of the analysts that everyone knows, they don't know history, or they don't want to talk about it. But in 1980, we had a peak in inflation. It was around 15% in the U.S. Okay. Now, officially, we have 8.3%. Okay, officially. But Dr. John Williams, who runs Shadow Stats, he calculates it the way they did in 1980, and he said it's actually 16.8%.
Yep.
So, and that puts us right in the range of all the big countries in Europe and so on. They also have big double-digit inflation right now. So our inflation rate is now much higher. But what the important thing is, our Fed funds rate right now is around 3.7%. Fed funds. That's the short-term interest rates. Where the Federal Reserve says that's the rate we want for short term. You know what it was in 1980 when we had inflation about like it is now? It was 20% Fed funds.
Jeez.
20% rate. People don't mention that. Maybe they don't know it or they're trying to hide it from people. But there's another thing that is not mentioned. Powell, Fed Chair Powell, not the last meeting, but the one before that, he said our goal is to have the spectrum of interest rates, spectrum meaning from short-term 90-day T-bills, let's say, to the long-end long-term bonds above the rate of inflation.
Oh.
Okay? So even if we take their phony rate of inflation, 8.3%, that means that interest rates will have to double from here.
Right.
From in the range of 4.5%, they're going to have to go over 8.3% to fulfill that. Nobody talks about that. Why are they hiding this? He said it on national TV. He said it. So this is so important. Interest rates are not anywhere near the bottom.